I want to thank you for being here with us for the Understanding 1031 Exchanges with a bonus on how to rescue a failing exchange. My name is Ruth Benjamin. I am a tax strategist. I am currently the General Manager of National 1031 Exchange Services. I've worked in the title companies. I've done escrow. I worked in the foreclosure companies. I did evictions and bankruptcies. I was a mortgage loan assistant and a legal assistant. But I spent 28 years as the president of two different 1031 exchange companies, and I am the founder of Financial Education Services, which is a credit repair business that helps people settle debts and also builds business credit on their corporations or their LLCs. So we're going to talk today about the Internal Revenue Code Section 1031. And Internal Revenue Code Section 1031 Tax Deferred Exchange represents a legal strategic method for acquiring or selling like-kind or qualified properties in order to defer capital gains tax. If a taxpayer meets the prescribed criteria as established by the Internal Revenue Service, then capital gains taxes may be deferred by exchanging property. People have been swapping properties since 1921. So they're exchanging their properties, but it wasn't under Section 1031. It wasn't until 1979 that T.J. Starker sued the IRS and won. So that established the Section 1031 code, and changes have been made since that time, and we're going to cover those today. So many people ask me what is considered like kind. So if you're selling your single-family residence, you can buy a condo, industrial building, golf courses, a retail space, farms and ranches, hotels and motels, and leases with 30 years or more remaining. And why the leases is important is if you don't have 30 years or more remaining on a lease where you're leasing the land from the state, then it's not considered real property. So in Hawaii, in some areas that happens, and I'm sure other parts of the United States also do that. So you need to make sure if you're leasing the land from the state that either if you're selling a property or buying a property that there's 30 years or more remaining on that lease. Multiple family rentals, offices, land, tenants in common, and Delaware statutory trust. So these that don't apply, that are not like kind, are primary residence, second homes, flips, and developments. Okay, so if you had a property and you were selling for $1.8 million, the cost basis is $450,000. You put $200,000 worth of improvement, and then you have depreciation recapture. But what is subject to capital gains tax is $1,248,181.82. The federal government's going to take 20% of that. The state of California is 13.3%. And then there's net investment income tax. People know it better as Obamacare. That's an additional 3.8%. So this person would be writing a check if there was no tax deferral strategy used. The text would be for $514,620.91. So let's talk about the delayed exchange steps. You need to talk to a tax advisor whenever you're doing an exchange, and then you're going to list your property for sale. Once you have a buyer for your property, you're going to open escrow with the title company, and then you would call the exchange company and get that order opened at that point also. So once you're going to close the transaction, you're going to sign the exchange agreement, normally with the title company or the attorney closer, but you're still going to deed the property to your buyer, a direct deed, okay? Then there is, once you close on the property, you have 45 days to identify the replacement property, and then you need to close on that property within 180 days. So an example of a fully tax-deferred exchange, if you're selling a property for $1 million, you must buy a property equal or greater to that $1 million. If you have $725,000 in equity, you must roll all that equity over to the replacement property. And if you have a loan balance of $275,000, you need to replace that loan on the replacement property of $275,000 or more. Now, on a partial tax deferred exchange, so if you sold for $1 million, but you only bought for 900,000, and you rolled all the equity over to the replacement property, but you ended up with a loan of 175,000 instead of 275. The IRS is going to look at the greater of the two trade down areas. So you have a trade down in sales price and you have a trade down in loan. So you would just be taxed on the greater of the two. Now, the crazy rules for 1031 exchange is the 45-day identification period. So the taxpayer must identify potential replacement properties by midnight of the 45th day from the date of the sale. And then you must acquire that property within 180 days. So the taxpayer must acquire the replacement property by midnight of the 180th day or the date of the taxpayer's tax return, including extensions for the year of the transfer of the relinquished property, whichever is earlier. So if you close a transaction after October 17th, you will need to file an extension to get to your 180th day. So the crazy rules about identifying is you have the 3 property rule. That's the most simple, basic rule where you can identify 3 properties and it doesn't matter what the value is. But remember, you got to meet your equal or greater requirement. So if you identify more than 3 properties, you'll hop into the 200% rule. So the 200% rule means that the total fair market value of all the properties you identified cannot go over 200% of the property you sold. So if you sold a property worth $1 million, all the properties that you combined 4 or more, then they cannot go over $2 million. But if you do go over $2 million, then you hop into the 95% rule. And that rule says that if you acquire 95% of the value of what you identified, then you're within the guidelines. So the other crazy rules with the 1031 exchange is the suggested holding period. So it's a suggested period. It's not a solid time period in the code. It's just what the IRS seems to like from all the private letter rulings and everything out there. But they like you to hold the property 2 years before you sell it, and also hold the property for 2 years, the one that you purchased. Now remember, it's not set in stone, it's a suggested holding period. Now, related parties. You cannot buy from a related party unless the related party is also doing an exchange. So when selling to a related party, the related party must hold the property for 2 years or it will disallow your exchange. So if you end up selling your property to your brother and your brother ends up, and you do your exchange, you move on to another property, but then your brother sells the property that he bought from you before 2 years, he's going to cause you to have to pay your taxes. So you want to be extra cautious with that. Now, related parties are brothers, sisters, spouses, ancestors, and lineal descendants. Related parties do not include step-parents, uncles, aunts, in-laws, cousins, nephews, nieces, and ex-spouses. Also be careful when you're dealing with corporations and LLCs. If you own more than 50%, it would be hard to transfer property back and forth because of the related party issues. Now also, if you take cash out of an exchange, that is considered boot and you must pay taxes right away. Now, a lot of people ask me about converting investment property to primary residence. You must own each of the relinquished property and replacement property for 2 years. Then when you go to sell the primary residence that came from a 1031 exchange, you must be on title for at least 5 years. The longer you live there, the bigger proration you get. However, the recapture from depreciation doesn't go away. So to illustrate the change, let's assume married taxpayers exchanged into a single family residence, rented it out for 3 years, moved into it, and lived in it for 2 years. The taxpayers then sold it and realized a gain of $500,000. So the exclusion would be prorated between the qualified and non-qualified use. The numerator is the period of non-qualified use and the denominator is the number of years the property has been owned. So 3/5 3 out of 5 years of the gain, or 300,000, would not be eligible for exclusion, and 2/5, 2 out of 5 years of the gain, or 200,000, would be eligible for the exclusion. As a consequence, the taxpayers would pay taxes on 300,000 of the gain, plus, of course, the depreciation recapture, instead of just paying the depreciation recapture. Now, second homes, if you want to consider a second home as an investment property, you need to have limited usage. That means not more than 14 days a year of using that property, or not more than 10% of the time that you have it rented out. So if you rent it for 300 days out of a year, you can use it 30 days. Now remember, working weekends don't count towards that usage time. If you have partnerships, if you own the property in a partnership and the partners all want to go their own way, you must dissolve the partnership 2 years before you can exchange the property. Now, I have seen people do what's called a drop and swap. So you really need to work closely with a tax advisor before you attempt doing it that way. Or one of the partners can buy out the one partner that wants his cash, and then they can go ahead and do the exchange after you had bought the partner outside of the exchange. Okay, if nobody wants to buy out the partner, but you still have one partner that wants to receive his cash, make sure you work closely with the tax advisors to see if there could be boot out of the exchange of the partnership, and if that boot can be allocated to that one partner. That is something you have to check with the tax advisor to see if that would work for you. Now, the 1031 tax filing requirements is IRS Form 8824. The main thing they're going to look at is, what was the description of the property you sold? What was the description of the property you purchased? Was it properly identified? The identification is one of the first things that they're going to take a look at, and they're going to make sure that you receive that property in time for the 180th days. So, required to complete your exchange within the 180 days or the date of your tax return is due, whichever is earlier. So remember, if the exchange is closed between October 17 and December 31st, you must file an extension to your tax return in order to receive the full 180-day reinvestment exchange, okay? The time period. Now, choosing a qualified intermediary, besides the strength of the intermediary, make sure they're bonded and insured. And it's like choosing an escrow officer. Who does good work for you? Who answers the phone? Who responds to your emails? Who can answer your questions and has a creative mind to help your deals get closed? When you're going to choose an intermediary, ask them how long have they been in this industry. How much experience do they have? And just not putting the information to create an agreement, but have somebody that can give you those ideas. Now, I have been doing exchanges for a really long time. Even if I'm not your accommodator, please feel free to call if you're running into a situation that you need to talk out. Now, if I can't answer your questions, we have a couple of attorneys that we work with, and one of them is ranked in the top 10 in the industry and has participated in getting laws written and passed. So, most common reasons 1031 exchanges fail. Now, this was, in some markets, there's not enough inventory. There's multiple offers, so that makes it difficult. Or your inability to qualify for a loan on the replacement property, which happens. The seller lost their job and can't qualify for a new loan. Or they can't find a property that was as good as the one they just sold. And believe it or not, the replacement property burned down. I had that happen. The client only identified one replacement property, and it was after the 45th day, so they couldn't identify any additional property. The property burned down, so then the exchange failed. There wasn't anything that could be done at that point. All right, so then we also had the seller end up in the hospital and couldn't close on a transaction. And I've had a situation where the seller started working for a startup company and hasn't been paid. So there's a lot of different reasons that exchanges can fail. Now, currently, about 40% of exchanges are failing. It used to be 60%. because the market has slowed up a little bit at this time. And like I said before, clients often state that if they knew what they were going to end up with, they would have never sold the property that they own because the property they ended up with was not as good. So what happens when an exchange fails? So taxes will be paid the following year. When you file your tax return, if it's been closed on January 1st through July 3rd. So January 1st to July 3rd, you will report the taxes that following April. But reporting the sale and your taxes will be after July 3rd, which is July 4th. Reporting the sale on your taxes will be to April 15th after you close, because you would then be receiving the proceeds from the sale after that year. It would be after December 31st, so you could actually report it an extra year later. Now, what happens when an exchange fails? Okay, there is a solution. So there's a legal review on transitioning funds from an IRC Section 1031 to an IRC Section 453. So this tax management memorandum has been around, and it was written by Robert W. Wood. Now, we do have this on our website if you would like to read it. The website is www.deferthegainstax.com. deferthegainstax.com. Go to resources and you will be able to find these memorandums and other resources. So set yourself up for success. Hire a 1031 accommodator that will release funds for the installment sale. So this is a clause out of National 1031 Exchanges Agreement, and it says, by initialing below, exchanger agrees to accept the exchange funds in the form of an installment note issued by NES, which is National Exchange Services, on terms and conditions to be agreed to by exchanger and NES within 15 days after the termination event. So the termination event is you can't identify, or you're not going to be able to acquire a property that you did identify. So what are commonly used IRC Section 453 options to rescue a failing exchange? The first one is a monetized installment sale. So the Office of the Chief Counsel of the IRS issued a memorandum of support in 2012 regarding the monetized installment sale. It is IRS Section 453, and this memorandum said that this strategy was good for the client and good for the economy. So a monetized installment sale defers capital gains taxes, the depreciation recapture taxes, and debt over basis taxes for 30 years. The cost is 6.7% of the net sales proceeds, and the net sales proceeds is calculated as the sales price minus the real estate commission and title company fees or attorney fees. So it's before any existing mortgage is paid off. And then there's a $300 per year invoice that you would receive. That's the only amount that would be surviving the close. So the seller is in full control of funds, and you can invest this loan funds in business or financial vehicle of choice. Now there's another strategy which is called the deferred sales trust. So you pay taxes as the principal is collected. That is determined by the contract. The cost is about 1 to 2% at close, but there's still a 1 to 2% annual fee. So it's a lot higher than the monetized installment sale. And it's managed by an independent trustee acting as a fiduciary. So you have limited control over your funds. So Easy has 1, 2, 3 strategy. So set up a 1031 exchange with an accommodator that cooperates with the monetized installment sale. So that would be our company, National 1031 Exchange Services. And there's another one, a few of them, so you can always call. You don't have to use our company, but you do want to use an accommodator that cooperates. So you have options. So you're going to look for at least 3 properties. We suggest you designate a Delaware Statutory Trust property as the third replacement property, or as a backup plan for the replacement properties to be designated within the 45-day requirement. This way, if nothing good is out there, you can identify a the Delaware statutory trust property, and your funds can be moved to real estate with passive income and the tax deferral offered with a 1031 exchange. So number 3, if nothing good and acceptable comes together in regards to a replacement property, then rescue the failing exchange with a monetized installment sale. Then the capital gains, straight line depreciation, and mortgage over basis taxes will be deferred for 30 years. So all of this hinges on hiring the right 1031 accommodator to begin with. So plan ahead and eliminate the need for 1031 exchanges or any other tax planning. So we have a trust, the Tax Deferral and Asset Protection Trust. We have a private letter ruling dated May 8th, 2015 for this wonderful trust. This unique type of trust is designed to protect your assets and to defer, reduce, or lessen taxes. It also eliminates liability and provides for beneficiaries without legally affecting the corpus of the trust. The corpus of the trust is not subject to turnover orders by any court or judge, whether federal, state, or local. So it adds extra liability protections that living trusts and LLCs do not. The cost for these trusts range from anywhere from about $50,000 to $140,000 plus, depending on the variations needed. So I want to thank you for attending this presentation today. If you have any questions, please call me, Ruth Benjamin, at 877-483-0427, or Scott Varney, my business partner, on the monetized installment sale and the trust strategy. And Scott also is very familiar with the 1031 exchanges. He can be reached at our office number 888-977-1222, and his calendar is calendly.com/Scott Varney. So again, I want to thank you, and please reach out to us. It is a free consultation on any of the items that you would like to talk about. I want to thank you for being with us today. We look forward to hearing from you.